Legal disclaimer. The content presented in this video series, including all spoken narration, visual aids, and accompanying materials, is strictly for educational and entertainment purposes only. It does not constitute financial, investment, legal, or tax advice. Foreign exchange trading, commonly known as Forex, involves a substantial risk of loss and is not suitable for every investor. The high degree of leverage often associated with Forex trading can work against you as well as for you. You should carefully consider your investment objectives, level of experience, and risk appetite before deciding to trade foreign exchange. There is a tangible possibility that you could sustain a loss of some or all of your initial investment, and therefore, you should not invest money that you cannot afford to lose. Historical data, back-tested results, and case studies discussed in this masterclass are provided for illustrative purposes only and do not guarantee future performance or success. The financial markets are dynamic, volatile, and unpredictable. We strongly recommend that you conduct your own independent due diligence and consult with a qualified, licensed financial advisor before making any investment decisions. By continuing to watch this video, you acknowledge that you are solely responsible for your own financial decisions and that the creators of this content bear no liability for any financial losses or damages incurred. There is a statistic in this industry that almost nobody likes to talk about, but it is the absolute mathematical reality of the world you are stepping into. It is called the 90-90-90 rule. It states that 90% of retail traders will lose 90% of their capital within their first 90 days of trading. Let that sink in for a moment. If you walk into this market with nothing but a funded account and a feeling of optimism, the statistical probability is that you are not the predator. You are the prey. You are not the person moving the market. You are the liquidity that the market moves to consume. Every single time you press buy, there is a counterpart on the other side of that terminal, often an institutional algorithm, a hedge fund manager, or a bank with deeper pockets and faster execution, who is betting that you are wrong. And historically, they are right. Most people enter the Forex market treating it like a slot machine. They see the trillion-dollar daily volume and think it is an ocean of free money waiting to be scooped up. They look at a chart, see it going up, and driven by the fear of missing out. Then the market reverses. They hold on, hoping it comes back. It drops further. Panic sets in. They close the trade at a loss, only to watch the market immediately reverse and go in their original direction. This isn't bad luck. This is a lack of strategy. This is what happens when you try to play a zero-sum game against professionals without understanding the rules of engagement. The market is not designed to pay you. It is an efficiency machine designed to transfer wealth from the impatient to the patient, from the uneducated to the strategic. But here is the open loop, the question that should be burning in your mind right now. Who are the other 10%? If 90% fail so catastrophically, what exactly are the surviving 10% doing differently? They are not smarter than you. They do not have a crystal ball. They do not have inside information. What they have is a comprehensive, battle-tested framework for interpreting data and managing risk. They don't just trade, they execute a business plan. Over the course of this 10-part deep dive masterclass, we are going to dismantle the gambling mindset and rebuild your approach from the ground up. We are going to explore why most strategies fail and how to construct a portfolio of strategies that aligns with the reality of how money actually moves between the Federal Reserve, the European Central Bank, and the major financial hubs of the world. This series is your bridge. It is the bridge between being a source of liquidity for the banks and becoming a disciplined operator who trades alongside them. We are solving a specific problem that plagues the U.S. retail trading sector today: the saturation of noise. You are bombarded with signals, indicators, bots, and influencers showing rented Lamborghinis. That is not trading. That is marketing. The problem we are solving is the lack of institutional structure in retail trading. We are going to strip away the hype and look at the raw mechanics of price delivery. We are going to examine how different strategies, scalping, swing trading, position trading, actually function under the hood, and crucially, which one fits your psychological profile and capital constraints. In this first installment, we are setting the foundation. You cannot build a skyscraper on quicksand, and you cannot build a trading career on misconceptions. Before we ever look at a candlestick pattern or a Fibonacci retracement, we must understand the environment we are entering. The foreign exchange market is the largest financial market in the world, with a daily turnover exceeding $7.5 trillion. To put that in perspective, that is significantly larger than the New York Stock Exchange. It is a beast that never sleeps during the week, driven by geopolitical events, interest rate differentials, and macroeconomic data releases. When you trade Forex, you are not trading a company stock based on earnings. You are trading the economic health of one nation against another. This masterclass is designed to be a comprehensive education. We are going to explore the mechanics of the major pairs, the influence of the US dollar index, and the critical importance of session overlaps. But more importantly, we are going to dive deep into the philosophy of edge. An edge is not a guarantee that you will win the next trade. An edge is a statistical advantage that plays out over a large sample size of trades. It is the realization that you don't need to know what is going to happen next to make money. You just need to know the probability of what might happen and how much it will cost you to find out. We will be dissecting the 3 pillars of successful trading strategies: technical analysis, fundamental analysis, and sentiment analysis. Most traders pick one and ignore the others. The technical trader ignores the interest rate decision and gets wiped out by a news spike. The fundamental trader ignores the price action and enters too early, getting stopped out before the move happens. The sentiment trader follows the herd and gets crushed at the turning point. We are going to show you how these 3 pillars interact. We will explore how a professional strategist uses fundamentals to determine the direction of the trade, technicals to time the entry of the trade, and sentiment to gauge the volume of the trade. Furthermore, we are going to address the elephant in the room: risk management. It is a boring topic to the amateur, but it is the obsession of the professional. Throughout this series, we will not just talk about stop losses in a vague sense. We will look at position sizing models, risk of ruin calculations, and the concept of asymmetric risk-reward ratios. You will learn why a strategy with a 40% win rate can be infinitely more profitable than a strategy with an 80% win rate, depending on the risk profile. This is the mathematics of survival. If you lose 50% of your account, you need a 100% gain just to get back to break-even. Understanding this math is more important than any indicator you can put on a chart. This journey we are about to embark on is not for the lazy. It is not for those seeking a quick fix to their financial problems. It is for the individual who is ready to treat trading as a serious profession. We will be looking at historical case studies of market bubbles and crashes to understand market memory. We will analyze the impact of high-frequency trading algorithms and how to avoid being trapped by them. We will define what it means to be a contrarian versus a trend follower, and why you need to know which one you are before you click a mouse. In the upcoming episodes, we will break down specific strategies step by step. We will look at the London breakout and why it works. We will analyze carry trades and how interest rates drive long-term flows. We will dissect mean reversion tactics for range-bound markets and momentum strategies for trending environments. But today, right now, your job is to accept the reality of the disclaimer we started with. The market owes you nothing. It is a neutral field of battle. To survive it, you must arm yourself not with hope, but with verified, back-tested, and statistically significant strategies. The goal of this series is to take you from a place of unconscious incompetence, where you don't even know what you don't know, to a place of conscious competence, where you are executing a strategy with precision, discipline, and emotional detachment. We are going to explore the psychology of the trader, discussing how fear and greed hijack the amygdala and force you to make irrational decisions, and we will provide you with the mental frameworks to override those impulses. So, if you are ready to stop gambling and start trading, if you are ready to move from the 90% who pay to the 10% who get paid, then you are in the right place. This is not just a video. This is the beginning of your professional education. We are going to peel back the layers of the Forex market one by one until you can see the machinery clearly. Prepare your notes, clear your distractions, and open your mind to a new way of viewing the global financial markets. Welcome to the deep dive. To understand the strategies we are about to dissect, you must first completely abandon the idea that the chart on your screen is a video game. It is not. It is a visual representation of mass human psychology and institutional necessity clashing in real time. Imagine for a moment that you are standing in a vast, chaotic room. In the center of this room, there are giants, massive entities that stand 50 feet tall. These are the Tier 1 banks: JP Morgan, Deutsche Bank, Citi, UBS. When they move, the ground shakes. When they breathe, the wind changes direction. They are not looking at you. They are looking at each other. They are exchanging billions of dollars of currency not to make a quick buck on a 5-minute candle, but to facilitate international trade, hedge immense corporate payrolls, and balance the books of sovereign nations. Now imagine you are in that same room. You are not a giant. You are an ant. You are standing near the feet of these giants trying to predict where they will step next so you can grab a crumb they dropped and run away before you get squashed. This is the reality of the retail Forex trader. The strategies we will explore in this series are essentially survival guides for ants living in a land of giants. If you try to stand in front of a giant and stop them, you will be crushed. That is what happens when you try to pick a top or a bottom against a strong trend. But if you learn to identify the footprint of the giant before the foot lands, you can hitch a ride on their shoelace. Let's look at a historical case study to prove this point. This is the story of the ultimate macro strategy play, often referred to as Black Wednesday, September 16, 1992. The giant in this story was the Bank of England. The trader who identified the footprint was George Soros and his quantum fund. At the time, Britain was part of the exchange rate mechanism, or ERM, which forced the British pound to stay within a specific price range against the German mark. The fundamental economic data showed that inflation in Britain was high and the economy was weak. However, the government was artificially propping up the currency to stay in the ERM. Soros did not look at a relative strength index or a moving average crossover to make his decision. He looked at the fundamental imbalance. He saw that the Bank of England's position was unsustainable. He knew that eventually the giant would trip. He began heavily shorting the pound, betting it would crash. When the pressure mounted, the Bank of England tried to fight back. They raised interest rates from 10% to 12%, and then to 15% in a single day to tempt investors to buy pounds. Imagine the volatility. Imagine the chaos on the trading floor. Most retail traders would have been wiped out by the erratic spikes. But the smart money, the strategy-driven capital, knew that an interest rate hike in a recession was an act of desperation, not strength. Soros kept selling. Eventually, the Bank of England ran out of foreign currency reserves to prop up the pound. They withdrew from the ERM and the currency collapsed. Soros made an estimated $1 billion in a single day. This example illustrates the hierarchy of strategies. Fundamental analysis, understanding the economic health of a nation, is the strategy of the long-term position trader. It moves slowly, then all at once. But you might be thinking, I don't have billions of dollars and I can't wait months for a trade to play out. This brings us to the more common realm of the retail speculator: technical analysis and market structure. However, even here, the ant versus giant analogy applies strictly. Consider the concept of liquidity. In Forex strategy, liquidity is simply the availability of orders to buy or sell. For a Tier 1 bank to enter a position worth $500 million, they cannot just click buy at the current market price. If they did, their own order would consume all available sellers, driving the price up aggressively and giving them a terrible average entry price. This is known as slippage. To avoid this, they need a counterparty. They need someone to sell to them so they can buy without moving the price too much. Now, imagine a scenario that happens every single day on the charts. You see a clear double top pattern. This is a classic textbook setup where price hits a ceiling twice, suggesting a reversal. You and thousands of other retail traders place your sell orders. You also place your stop-loss orders just above the highs of that double top, thinking you are protecting your capital. To the market maker algorithms, those stop-loss orders represent one thing: a pool of buy orders. Remember, if you are short, your stop-loss is a buy order. The giants need to buy a massive amount of currency. They see that pool of liquidity sitting right above the double top. What happens? The price doesn't go down immediately. Instead, it surges up, pierces through the double top, triggers all those stop losses, and fills the institutional buy orders. The retail traders are stopped out, frustrated, thinking the market is rigged. Then, moments later, the price collapses in the direction they originally predicted. This is not a conspiracy. It is a mechanism of market efficiency. The smart money strategy involves identifying where these liquidity pools are, where the dumb money has placed their obvious stops, and trading with the institution that is hunting them. When we explore strategies later in this series, we will categorize them by how they interact with this liquidity. We have scalping, which is high-frequency decision-making. A scalper is trying to grab crumbs from the volatility created by these liquidity grabs. They might hold a trade for minutes or even seconds. They are not concerned with the GDP of a country. They are concerned with the immediate order flow. Then we have swing trading, which seeks to capture a single leg of a trend, perhaps lasting a few days or weeks. A swing trader looks for the market to breathe, expansion and contraction. They want to enter when the giant takes a step and exit before the giant shifts weight. Let's run an imagine if scenario for a swing trading setup to solidify this. Imagine you are looking at the US dollar against the Japanese yen. The trend is clearly upward because the US Federal Reserve is raising interest rates while the Bank of Japan keeps them negative. This is the fundamental backdrop. However, for 3 days the price has been dropping. A novice trader looks at the red candles and thinks, the trend is over, time to sell. A strategic swing trader looks at the same chart and sees a pullback. They use a tool like the Fibonacci retracement, which we will detail in future episodes, to measure the depth of the drop. They are waiting for the price to hit a discounted level, a price point where the institutions are likely to reload their buy orders. They are not chasing the red candles. They are stalking the entry for the next green wave. The difference between the novice and the professional is that the novice reacts to what is happening now, while the professional positions themselves for what is likely to happen next based on historical probability. The novice chases the price. The professional lets the price come to them. This patience is the hardest skill to master. It is often said that trading is 10% buying, 10% selling, and 80% waiting. As we move deeper into this masterclass, we are going to start unpacking the specific toolkits you need to execute these maneuvers. We have established that the market is a hostile environment, dominated by massive institutional flows. We have established that price moves in search of liquidity. We have established that fundamentals drive the long-term trend, while technicals dictate the short-term entry. But how do you actually read the language of the market? How do you look at a bar chart and see the battle between buyers and sellers? This brings us to the concept of price action, the rawest form of data available to us. Before indicators, before moving averages, before complex algorithms, there is just open, high, low, and close. In the next part of this series, we are going to strip your charts naked. We are going to remove every single distracting line and color to focus on the pure psychology of the Japanese candlestick. You might think you know what a hammer or a shooting star is, but do you know the story it tells about order flow? Do you know why a hammer candle at the top of a trend means something completely different than a hammer at the bottom? We are going to decode the secret language of candlesticks and show you how to spot a reversal before it even happens on the indicators. The question is, can you handle trading without the training wheels of your favorite indicators? We're about to find out. Most traders are terrified of a blank chart. If you strip away the moving averages, delete the Bollinger Bands, and hide the RSI, they feel blind. They feel like they are driving a car at night with the headlights turned off. But the reality is the exact opposite. Those indicators are not the road. They are the rearview mirror. They tell you what happened 10 minutes ago, or 10 hours ago, averaged out into a smooth line that looks comforting but often hides the jagged reality of the moment. By relying on them, you are reacting to old data. To trade with the smart money, you need to look at the windshield, and the windshield is price action. Specifically, we need to master the art of the Japanese candlestick. Shutterstock. This is not a modern invention. This method of charting was developed in the 18th century by a Japanese rice trader named Munehisa Homa. He realized that while the supply and demand of rice determined the fundamental value, the price was heavily influenced by the emotions of the traders: fear, greed, panic, and exuberance. He developed candlesticks to visualize these emotions. When you look at a candle, you are looking at a battle map between buyers, bulls, and sellers, bears, over a specific period. Whether that period is 1 minute or 1 month, the anatomy is the same, and understanding this anatomy is the first step to financial literacy in the markets. Every candle tells a story with 4 data points: the open, the high, the low, and the close. The body of the candle, the thick part, represents the distance between the open and the close. This tells us who won the round. If the close is higher than the open, the bulls won. If it is lower, the bears won. But the real secrets, the clues that the institutional algorithms leave behind, are often found in the wicks, or the shadows. The wick represents rejection. It shows you where the price went but could not stay. Let's visualize a specific scenario to understand the power of the wick. Imagine you are watching the euro to US dollar pair. It has been dropping for 3 days. The sentiment is bearish. Everyone is selling. The price hits a major round number, say 1.1000. Aggressive sellers try to push it lower to 1.0980. For a moment it looks like a breakout. But then huge limit buy orders, placed by large institutions hedging their currency exposure, kick in. The price stops dead, starts to creep back up. By the time the hour closes, the price is back at 1.1010. What does the candle look like? It has a small body at the top and a very long wick sticking out the bottom. This is known as a pin bar or a hammer. That long lower wick is not just a line on a screen. It is a footprint of failure. It tells you that the bears tried to push the price down, put significant capital behind it, and were completely overwhelmed by the bulls. The market rejected the lower prices. This is actionable intelligence. It suggests that the path of least resistance has flipped from down to up. Shutterstock. However, context is everything. A hammer candle floating in the middle of a consolidation range means absolutely nothing. It is noise. But that same hammer candle occurring at a multi-year support level, or bouncing off a 200-day moving average, is a high-probability reversal signal. This is where novice traders fail. They memorize the shape but ignore the location. You would not buy a house just because it has a nice front door. You buy it because of the neighborhood. In trading, the chart location is the neighborhood, and the candlestick is the house. Let's go deeper into a more aggressive pattern. The engulfing bar. This is a two-candle formation that signals a massive shift in momentum. Imagine the market is ticking upward slowly. We see a green candle of average size. Then the next candle opens perhaps slightly higher, but then immediately crashes down, closing significantly lower than the open of the previous candle. Visually, the body of the red candle completely engulfs or swallows the body of the previous green candle. Shutterstock. Explore. What does this tell us about the order flow? It tells us that in the second time period, the sellers became so aggressive that they completely erased all the buying pressure from the previous period and then added new selling pressure on top of it. It is a violent seizure of control. If you see a bearish engulfing pattern at the top of an uptrend, it is often the first sign that the smart money is offloading their positions to the late retail buyers and initiating short positions to drive the market down. Now let's apply the concept of fractals to these candlesticks. This is a deep dive concept that will change how you view timeframes. A candlestick on a daily chart represents 1 day of trading, but inside that single daily candle are 24 one-hour candles. If you see a massive wick on a daily candle, and you zoom into the 1-hour chart, what will you see? You will likely see a trend going down, a consolidation, and then a strong trend going back up. The wick on the higher time frame is actually a V-shape reversal, or a market structure shift on the lower time frame. Understanding this fractal nature allows you to time your entries with sniper-like precision. You don't just see a daily pin bar and hit buy. You see the daily pin bar, recognize the rejection, and then drop down to the 1-hour or 15-minute chart to find a precise entry point with a tighter stop loss. This drastically improves your risk-to-reward ratio. Instead of risking 50 pips to make 100, you might be risking 10 pips to make 100. That is a 110 risk-reward scenario, which allows you to be wrong 9 times and right once and still break even. But a word of caution, and this is critical. Amateurs trade the tick, professionals trade the close. You must wait for the candle to close before you make a decision. A candle that looks like a bullish hammer with 5 minutes left in the hour can easily collapse and turn into a bearish engulfing candle in the final seconds as algorithms balance their books. This is a classic bull trap. You enter early thinking you are smart, and the market snaps back and traps you in a losing trade. Patience is a technical skill. Waiting for the clock to hit 0 is a strategy in itself. We also need to discuss the psychology of the doji. A doji is a candle where the open and close are almost identical, looking like a cross or a plus sign. It represents indecision. The buyers pushed up, the sellers pushed down, and neither won. The market is in equilibrium. When you see a doji after a long aggressive trend, it is a warning sign. It's like a runner gasping for breath. The momentum is fading. It doesn't guarantee a reversal, but it tells you that the force driving the trend has temporarily vanished. If the next candle breaks the low of the doji, the reversal is often confirmed. We have now stripped the chart naked. We have learned that the candlestick is the raw data of human emotion and institutional intent. We know that a wick is a rejection, an engulfing bar is a takeover, and a doji is indecision. But individual candles are just the words in a sentence. You cannot understand a book by reading one word at a time in isolation. You need to understand the grammar. You need to understand how these candles string together to form the narrative of the market. This narrative is called market structure. It is the map of the battlefield. It tells us if we are in an uptrend, a downtrend, or a range. It tells us where the higher highs and lower lows are. Most importantly, it helps us identify the exact point where a trend is broken and a new one begins. You might be able to spot a reversal candle now, but if you try to trade a reversal candle against a raging structural trend, you will get run over. So, how do you identify the invisible skeleton of the market? How do you know when a pullback has turned into a reversal? How do you spot the difference between a market that is resting and a market that is turning? In the next part of this masterclass, we are going to connect the dots. We are going to zoom out and learn to read the waves of the market, identifying the crucial swing points that define the trend. If you think reading one candle is powerful, wait until you see what happens when you can read the entire structure. The map is about to unfold. Market structure is the Rosetta Stone of trading. Without it, you are simply reading gibberish. You might recognize a few words like a hammer candle or a double top, but you will never understand the sentence, let alone the entire story. If candlesticks are the individual footsteps of the market participants, market structure is the path they are walking on. It tells you the destination. It tells you who is in control. The aggressive buyers pushing for new heights, or the dominant sellers defending their territory. Shutterstock. Explore. At its core, market structure is the study of peaks and valleys. It is the rhythmic, heartbeat-like movement of price as it breathes in and out. In a healthy bullish economy, an uptrend, the market does not move in a straight line. It moves in a staircase pattern. It surges up to make a higher high, pushing past the previous ceiling. Then it exhausts itself. Profit-taking kicks in. The price pulls back, but, and this is the critical part, it does not fall below the starting point of the surge. It stops at a higher low. This higher low is the floor. It is the price point where the bulls step back in, defending their position, confirming that demand still exceeds supply. As long as this sequence of higher highs and higher lows remains unbroken, the trend is your friend. You are swimming with the current. The mistake 90% of traders make is trying to predict the end of the staircase. They see the price go up for 3 weeks and think, it can't possibly go higher. So they sell. They try to short the market. But the market doesn't care about their opinion. It pulls back to a higher low, traps the short sellers, and then blasts off to a new higher high, liquidating their accounts. This is why the first rule of professional strategy is simple: identify the structure and then submit to it. Conversely, a downtrend is a sequence of lower lows and lower highs. This is an environment of pessimism and liquidation. Every time the market tries to rally, it fails to breach the previous peak, creating a lower high, and then collapses to a new depth, a lower low. If you are buying in this environment, you are catching a falling knife. You might get lucky once or twice, catching a dead cat bounce. But statistically, the weight of the market is crushing you. Now let's introduce the concept of the structural break, or break of structure. This is the precise moment when the tide turns. Imagine a strong uptrend. We have a clear higher high, followed by a higher low. The market surges again, but this time it fails to make a new higher high. Stalls. It runs out of oxygen. This is the first warning sign. But the trend is not dead yet. The death of the trend occurs when the price turns around and violently crashes below the previous higher low. When that previous structural floor is breached, the definition of the uptrend is violated. The staircase is broken. This is often referred to as a change of character or a market shift. The bulls who were defending that floor have been overrun. Their stop losses have been triggered. The psychology has shifted from buy the dip to sell the rally. A professional strategist does not guess when the trend will end. They wait for this specific structural break to confirm it. They sacrifice the first 10% of the move to ensure they are on the right side of the remaining 90%. Let's apply this to a real-world scenario. Imagine the euro to US dollar pair has been climbing for a month. You see a massive red candle. The news says inflation is rising. The retail crowd panics and hits sell. But you look at the structure. Has the previous higher low been broken? No. The price is simply retracing. The professional sees this red candle not as a reversal, but as an opportunity to buy at a discount. They wait for the price to hit that structural support, and when they see a confirmation candle like the hammer we discussed in the previous episode, they enter long. The retail traders who panic sold are now trapped as the trend resumes its journey upward. However, there is a layer of complexity we must address. Fractal structure. The market is like a Russian nesting doll. Inside a weekly uptrend, there can be a daily downtrend. Inside that daily downtrend, there can be a 1-hour uptrend. This is where confusion reigns for the amateur. They look at the 5-minute chart and see a change of character to the upside and think, buy. But they fail to check the 4-hour chart, which shows they are buying directly into a massive structural resistance level, a lower high of the bigger picture. This is called multi-time frame analysis. It is non-negotiable. You must align your strategy like the gears of a clock. The big gear, the higher time frame, determines the direction. The small gear, the lower time frame, determines the entry. A classic strategy used by hedge funds is the top-down approach. They identify the structural trend on the daily chart. Let's say it's bearish. They then forbid themselves from clicking buy. They are only allowed to sell. They drop down to the 1-hour chart and wait for a localized rally, a pullback against the main trend. Then they zoom into the 15-minute chart and wait for a micro break of structure to the downside. This alignment of the stars, daily bearishness, hourly pullback, 15-minute confirmation, provides the highest probability setup possible. You are selling when the wind, the tide, and the waves are all pushing you in the same direction. Let's consider and imagine if regarding the strong high versus weak high concept. This is a subtle nuance that separates the pros from the struggling intermediates. A strong high is a peak that successfully caused a lower low. Did its job. It had enough selling power to break the structure. Therefore, institutions likely have orders protecting that high. A weak high, on the other hand, is a peak that failed to break the structure. It failed to make a lower low. Because it failed, it is weak. Why does this matter? Because weak highs are targets. If you are shorting the market, you never want to place your stop loss above a weak high, because the market is magnetically drawn to run through it to find liquidity. Conversely, a strong high is a fortress. It is defended. Identifying which highs and lows are strong or weak allows you to place your stop losses in places where the market is statistically unlikely to go, rather than placing them exactly where the market is hunting. We are now building a complete picture. We know the disclaimer. This is risky business. We know the mindset. We are ants among giants. We know the signal, the candlestick. And now we know the map, market structure. We can see the trend, we can spot the break, and we can identify the strong points to defend. But there is a gaping hole in our strategy. We know what to look for, a structural shift, and when to look for it, aligned timeframes. But we still don't know exactly where to enter. If the market breaks structure and starts to retrace, where does it stop? Does it retrace 50%? 60%? Does it come back to the origin of the move? This is where the concept of supply and demand enters the equation. It is the economic law that governs everything from the price of avocados to the price of gold. On a chart, there are specific invisible zones where institutional orders are stacked waiting to be filled. These zones act like magnets. They pull price in and then repel it violently. In the next part of this masterclass, we are going to learn how to draw these zones with precision. We are going to stop guessing where the pullback ends and start identifying the exact coordinates where the banks are waiting to do business. We are going to explore the order block. Get ready, because we are about to pinpoint the heartbeat of the market. An order block is not a magical pattern. It is a footprint of institutional necessity. To understand it, we must step entirely out of the retail mindset and step into the boardroom of a central bank or a massive hedge fund. We establish that these entities deal in volumes that the market cannot immediately absorb. If JP Morgan wants to buy 1 billion euros, they cannot simply hit buy at the market price. There aren't enough sellers at that specific price point to fill the order. If they tried, they would slip the price upward by 50 or 100 pips, destroying their own profit margin before the trade even begins. Shutterstock. Explore. So what do? They engineer liquidity. They construct a scenario where the retail market feels compelled to sell. They might push the price down aggressively, breaking a minor support level. Seeing this breakdown, retail traders panic and sell. Stop losses below the support are triggered, which, remember, are sell orders. This creates a flood of selling pressure. Who is on the other side of that flood? The bank. They are absorbing all those sell orders, effectively buying at a wholesale price. Once their order is filled, they release the pressure, and the price rockets upward, leaving the retail sellers trapped and the bank in massive profit. But here is the catch, and this is the secret to the order block strategy. To drive the price down initially to create that panic, the bank had to open a short position. They had to sell to push the price down so they could buy at the bottom. When the price rockets up, their massive buy position is in profit, but that initial manipulation short position is now in a deep drawdown. It is losing money. Banks do not like losing money. Therefore, the bank has a vested interest in bringing the price back down to the level where they opened that manipulation short. They want the price to return to the scene of the crime. When the price returns to that specific zone, they close their short positions at break-even. This closing of short positions, which requires buying, adds more buying pressure to the market. Simultaneously, they often add to their long positions. This double force of buying causes the price to explode upward for a second time. This specific zone, the last sell candle before the explosive buy move, is the bullish order block. It is not just a support level, it is a zone of mitigation. The bank is mitigating their losses on the manipulation leg. Your strategy, as the astute ant following the giant, is to place your buy limit orders at the top of this order block. You are waiting for the return. You are waiting for the bank to come back to balance their books. Let's visualize a bearish scenario to ensure this is crystal clear. Imagine the market is in an uptrend, but it hits a level where a large institution wants to sell. They need buyers to sell to, so they drive the price up one last time, creating a frenzy of FOMO, fear of missing out. Retail traders see a big green candle and jump in buying at the top. The institution sells into this buying pressure. Then the price collapses aggressively, breaking market structure to the downside. This creates a bearish order block, the last up candle before the collapse. Shutterstock. Explore. Now the institution is short and in profit, but they still have those initial buy positions they used to drive the price up. Those buys are underwater. The market will often drift back up slowly and correctively until it taps that last up candle. As soon as it touches it, the institution closes their bad buy trades and unleashes the rest of their selling volume. The price drops like a stone. If you were trying to buy that retest thinking it was a breakout, you were liquidated. If you identified the order block, you were shorting exactly when the smart money was mitigating. However, not every candle is an order block. If you traded every reversal candle, you would lose your account in a week. We need filters. We need criteria to identify high probability order blocks. The first and most important filter is the imbalance or fair value gap, FVG. When an institution enters the market, they do it with such ferocity that the price moves too fast to fill all orders at every price point. Imagine a candle that is huge and green. It opens at 1.0500 and closes at 1.0550. The candle before it ended at 1.0490, and the candle after it started at 1.0560. Between the high of the first candle and the low of the third candle, there is a gap. A section of price action where only buying occurred, and no selling overlap happened. This is an inefficiency in the market. The algorithm that delivers price views this as a gap that needs to be filled. A high probability order block must be followed by this imbalance. The imbalance acts as a vacuum or a magnet. It pulls the price back towards the order block. If there is no imbalance, if the price action is messy and overlapping, it means the orders were efficiently paired, and there is no strong reason for the price to return. You should ignore those blocks. We are looking for the violent moves, the ones that leave a scar on the chart. The second filter is the break of structure we discussed in part 4. A valid order block must have caused a break of structure. If a bullish order block pushes price up but fails to make a higher high, it is weak. Failed its mission. Why would you trust a level that couldn't even break the previous high? We want to trade off the backs of the giants who are strong enough to shatter the previous structure. So the formula becomes order block plus imbalance plus break of structure equals high probability entry. Let's refine the entry technique itself. A novice identifies the block and sets a limit order at the very edge. This is risky. Sometimes the price will smash right through the block. A professional refines the zone. They might look at the mean threshold, the 50% mark of the order block's body. Historically, algorithms respect the 50% level of the institutional candle with incredible precision. Placing your entry there offers a better risk-to-reward ratio. Or they might zoom down to a lower time frame. If you see a 4-hour order block, you don't just buy blindly. You wait for price to tap into it, then you go to the 15-minute chart and wait for a new 15-minute break of structure to the upside inside the 4-hour zone. This is called confirmation entry. It reduces your win rate slightly because sometimes you miss the trade, but it drastically increases your survival rate because you avoid catching falling knives. We must also touch on the concept of premium versus discount. This is derived from basic commerce. You want to buy low discount and sell high premium. If you take a Fibonacci tool and measure the current trading range from the swing low to the swing high, the 50% level is the equilibrium. Institutions generally do not buy above the 50% mark. That is expensive. They wait for the price to drop into the discount zone, below 50%, before loading their buy orders. Conversely, they look to short in the premium zone, above 50%. If you see a beautiful bullish order block, but it is located in the premium zone at the very top of the range, the probability of it holding is low. The smart money is not buying there. They are taking profits. By combining these elements, you are no longer guessing. You are constructing a narrative. The overall trend is bullish structure. The price is in a discount location. It is approaching a bullish order block that caused a break of structure footprint. There is an imbalance drawing price into it. Magnet. This is a professional trade plan. But even with this level of precision, there is one variable we have completely ignored. A variable that can turn a perfect setup into a losing trade in seconds. The market is not a static environment. It is a time-bound beast. The euro does not move with the same volatility at 5 p.m. New York time as it does at 3 a.m. London time. You can have the perfect level, the perfect structure, and the perfect candle, but if you try to execute the trade when the banks are closed or during a low-volume dead zone, you will likely get stopped out by meaningless chop. Timing is the fourth dimension of the market. There are specific windows of time, often called kill zones, where the volume spikes and the true moves happen. If you are entering trades outside of these windows, you are essentially trying to surf in a lake. You need the ocean swell. In the next part of this masterclass, we are going to synchronize your watch with the interbank delivery algorithm. We are going to explore the London Open, the New York overlap, and the specific times of day when false moves are created to trap the unwary. You know the what and the where. Now you need to learn the when. If you try to apply the strategies we have discussed, market structure, order blocks, and candlestick analysis at 5 p.m. New York time, you will lose money. It does not matter how perfect the technical setup looks. It does not matter if the RSI is oversold, or if there is a beautiful bullish engulfing pattern. The market at that hour is a graveyard. The spreads widen, the liquidity evaporates, and the price action becomes jagged and nonsensical. This is because the smart money has gone home. The algorithms are in a holding pattern. Trading is often sold as a freedom lifestyle where you can make money anytime, anywhere. This is a half-truth that leads to full bankruptcies. While the Forex market is technically open 24 hours a day, 5 days a week, it is not tradable 24 hours a day. It breathes. It has pulses of high-octane volatility, followed by long periods of dormancy. If you are not synchronized with these pulses, you are swimming in a stagnant pond, paying fees to your broker for the privilege of watching paint dry. Or worse, getting stopped out by random low-volume noise. To trade like a professional, you must divide your day into 3 distinct chapters or sessions, each with a specific psychological profile and a specific job to do in the grand scheme of price delivery. These are the Asian session, the London session, and the New York session. Getty images. Let's start with the Asian session, which kicks off around 8 p.m. Eastern Standard Time, depending on daylight savings. New traders hate this session. They call it boring. The price usually moves in a tight, narrow range, consolidating sideways. But the professional loves the Asian session not to trade it, but to mark it. This consolidation is called the Asian range. Think of this range as a pressure cooker building up steam. During these hours, liquidity is being engineered. Above the high of the Asian range, there are stop losses from early sellers. Below the low of the Asian range, there are stop losses from early buyers. To an institutional algorithm, the Asian range is simply a menu of liquidity that will be consumed later. The narrative shifts dramatically when Frankfurt opens, followed closely by the London Open at 3 a.m. Eastern Standard Time. This is when the sleeping giant wakes up. Europe is the financial hub of the Forex world, handling a massive percentage of daily transaction volume. When London comes online, the volatility injection is immediate and violent. This brings us to one of the most powerful time-based strategies in existence, the Judas swing. Imagine the Asian range has established a clear resistance level. It is 3 a.m. Suddenly, the price blasts upwards, breaking the Asian high. Retail traders waking up in Europe see this breakout. Their textbooks tell them resistance broken equals buy. They jump in long. They chase the momentum. But this move is a lie. It is a false breakout designed to trigger the buy stop's liquidity, sitting above the Asian high. The banks sell into this buying frenzy. Once the liquidity is absorbed, the trap snaps shut. The price aggressively reverses, dropping back into the range and plummeting through the bottom, triggering the stops of everyone who just bought. This initial false move, the Judas swing, sets the high or low of the day. If you look at a daily candle, you see a wick at the top or bottom. That wick was likely formed during the London Open manipulation. The strategy here is counterintuitive. You do not buy the breakout at 3 a.m. You wait for the rate of the liquidity, the structural breakdown back inside the range, and then you enter in the opposite direction of the initial move. You are trading the failure, not the breakout. Then the narrative evolves again as we approach the New York session, specifically the New York Open at 8 a.m. Eastern Standard Time. This is where the heavyweights of the U.S. financial system enter the arena. But there is a twist. For a few hours from 8 a.m. to around 11 a.m. Eastern Standard Time, London and New York are open simultaneously. This is the London-New York overlap. It is the most liquid, volatile, and dangerous time of the day. During this overlap, two things usually happen. Either the trend established in London is continued with fresh fuel, creating a massive expansion move, or New York reverses the London trend entirely. This is where time-of-day filtering saves your account. If the market has already moved 100 pips in one direction during London, statistical probability suggests it is exhausted. Buying after a 100-pip move just because New York opens is suicide. Instead, a smart strategist looks for a retracement during the New York lunch hour, around 12 p.m. Eastern Standard Time, or a reversal during the overlap. This brings us to the concept of kill zones. These are specific 3-hour windows where you should be hunting for your order blocks and fair value gaps. If you see an order block form at 4 p.m. Eastern Standard Time, ignore it. It is weak. If you see the same order block form at 8:30 a.m. Eastern Standard Time, right as economic news is released, it is high probability. The algorithm seeks to rebalance price during these specific operating hours. A London kill zone trade 2 a.m. to 5 a.m. Eastern Standard Time, and a New York kill zone trade 7 a.m. to 10 a.m. Eastern Standard Time are worth 10 times more than a trade taken outside these windows. Let's apply an imagine if scenario to solidify the importance of the daily profile. Imagine it is Tuesday. Historical data shows that the low of the week, or high of the week, usually forms on a Tuesday or Wednesday. This is not superstition. It is the weekly cycle of liquidity accumulation and distribution. So it is Tuesday morning during the London Open. The trend for the week has been down. You see the price drop aggressively. A novice thinks the downtrend is continuing. But you, the strategist, know that it is Tuesday, and we are likely hunting for the weekly low. You see the price smash into a higher timeframe demand zone. Instead of selling the drop, you wait. You see the Judas swing clear out the lows of Monday. Then, you see a violent displacement upwards breaking structure. This is not just a trade. This is the formation of the weekly low. By aligning the time, Tuesday London Open, with the price, demand zone, you catch the absolute bottom of the weekly move, allowing you to hold the position for days as the market expands. This chronological discipline also applies to macroeconomic data. At 8:30 a.m. Eastern Standard Time, the U.S. often releases high-impact news like the CPI, Consumer Price Index, or NFP, non-farm payrolls. These events are the injectors of volatility. A common amateur mistake is to try and predict the number. I think inflation will be down, so I will buy. That is gambling. The professional strategy is to wait. When the news drops, the algorithm goes crazy. It spikes up and down, widening spreads, taking out liquidity on both sides. This is often called clearing the board. The strategy is to sit on your hands for 15 minutes. Let the dust settle. Let the manipulation occur. Once the initial spike is over and the true direction is revealed by a break of structure after the news, that is when you enter. You let the news act as the catalyst to push price into your order block, and then you execute. You do not trade the news, you trade the reaction to the news. By now you should feel a shift in your perspective. The chart is no longer just lines. It is a 24-hour narrative of accumulation, manipulation, and distribution. We have the technical tools, candlesticks, structure, order blocks. We have the temporal tools, sessions, kill zones, weekly cycles. You have a complete engine. But an engine is useless without fuel. And in the Forex market, the fuel is not just money. The fuel is the relationship between currencies. You cannot trade the euro in isolation. The euro moves because the dollar moves, or because the British pound moves. There is a hidden web of invisible strings connecting every single pair on your watch list. If you buy euro to US dollar and sell pound sterling to US dollar at the same time, do you realize you might be effectively taking the same trade twice, doubling your risk without realizing it? This is the world of correlations and currency strength. It is the final piece of the analytical puzzle before we talk about money management. In the next part, we are going to learn how to play the pairs against each other. We will discuss the Dixie US dollar index and how it acts as the master conductor for the entire market. We are going to show you how to avoid the risk of ruin by understanding which pairs move together And which pairs are sworn enemies? The web is complex, but we are about to untangle it. To navigate the Forex market without monitoring the US dollar index is akin to sailing a ship without checking the wind direction. You might be focused entirely on the sails, your specific currency pair, but if the wind is blowing against you, you are going nowhere. The US dollar is the reserve currency of the world. It is the sun in the solar system of Forex. Every other major currency, the euro, the yen, the pound, orbits around it. Roughly 85% of all Forex transactions involve the US dollar on one side of the trade. Therefore, before you ever analyze a pair like euro to US dollar or pound sterling to US dollar, you must first analyze the dollar itself. Professionals call it the DXY or the DXY. It is not a currency pair you trade directly for profit in most retail accounts, but it is the ultimate leading indicator. The DXY measures the strength of the US dollar against a weighted basket of 6 major currencies. The euro makes up the largest chunk of this basket, accounting for nearly 58% of the weight. This means that mathematically, the DXY and the euro to US dollar pair are almost perfect mirror images of each other. Imagine if you are looking at a setup on euro to US dollar. You see a bullish order block. You see a break of structure. You are ready to buy. But then you switch tabs to the DXY chart. You see that the dollar index has just hit a massive multi-year support level and is forming a bullish reversal pattern. If the dollar is about to surge in value, the euro is mathematically forced to drop against it. In this moment, your perfect euro to US dollar buy setup is a trap. The DXY has just saved you from a losing trade. This is the power of intermarket analysis. You are using the strength of the dollar to filter the noise of the individual pairs. This brings us to the critical concept of correlation. In Forex, currencies do not move in isolation. They move in packs. We have positively correlated pairs and negatively correlated pairs. Positive correlation means two pairs move in the same direction. Historically, euro to US dollar and pound sterling to US dollar have a strong positive correlation. If the euro is rising against the dollar, the British pound is likely rising against the dollar as well. Negative correlation means they move in opposite directions. US dollar to Swiss franc, the US dollar against the Swiss franc, often moves inversely to euro to US dollar. Here is the nightmare scenario that destroys thousands of retail accounts every year. It is the illusion of diversification. Let's run a case study. Imagine a trader named John. John scans the markets and finds 3 setups. He decides to buy euro to US dollar because it looks bullish. He decides to buy pound sterling to US dollar because it also looks bullish. And finally, he decides to sell US dollar to Swiss franc because it looks bearish. He thinks, I am smart. I am diversified. I have 3 different trades running. John is not diversified. John has effectively taken the exact same position 3 times. He is betting against the US dollar with 3 times his normal leverage. He has tripled his risk exposure on a single idea. Dollar weakness. If the US dollar suddenly spikes due to an unexpected news event, John doesn't just lose 1 trade. He loses all 3 trades instantly. His account suffers a catastrophic drawdown because he failed to understand that he was over-leveraged on the correlation. A professional strategist looks at those 3 setups and picks the one that looks the cleanest, ignoring the other 2 to preserve capital. Now let's look at the cross pairs. These are pairs that do not include the US dollar, such as euro to Japanese yen, euro against yen, or pound sterling to Australian dollar, pound against Australian dollar. Many traders think these move independently of the dollar, but that is a mathematical impossibility. These are synthetic pairs. The price of euro to Japanese yen is actually calculated by multiplying the price of euro to US dollar by the price of US dollar to Japanese yen. The dollar is the invisible bridge connecting them. This gives us a powerful strategic edge. If euro to US dollar is trending up, euro is strong, dollar is weak, and US dollar to Japanese yen is also trending up, dollar is strong, yen is weak, what happens to euro to Japanese yen? We have a strong euro and a weak yen. The cross pair will explode upwards with massive momentum, often moving faster and farther than the majors. Identifying these moments where the math of the crosses aligns is how you catch those 200 or 300 pip moves in a single session. We must also discuss the concept of risk on and risk off. This is the psychological tide of the global economy. Capital flows like water. It seeks the path of least resistance and highest safety. When the global economy is stable, stocks are rising, and fear is low, we are in a risk-on environment. Investors feel brave. They sell safe haven currencies to buy high-yield assets. In a risk-on world, you typically see the Australian dollar AUD, New Zealand dollar NZD, and Canadian dollar CAD perform well. These are commodity currencies. Australia exports iron and gold. Canada exports oil. When the world is growing, it needs these resources, driving up the value of these currencies. Conversely, in a risk-off environment, triggered by war, pandemics, or financial crashes, investors panic. They dump risky assets and flee to safety. The primary safe havens are the US dollar, cash is king, the Japanese yen, and the Swiss franc. If you see headlines about a geopolitical crisis breaking out, and you are holding a long position in Australian dollar to Japanese yen, Australian dollar against the yen, you are standing in front of a freight train. The market will instantly dump the risky Aussie dollar and aggressively buy the safe Japanese yen. The pair will collapse. Understanding the macro sentiment allows you to position yourself with the fear or the greed of the herd, rather than being trampled by it. There is also an advanced concept used by institutional traders called SMT divergence, or correlated pair divergence. This is a specific signal that hints at accumulation or distribution. Let's go back to euro to US dollar and pound sterling to US dollar. Since they are correlated, if euro to US dollar makes a lower low, pound sterling to US dollar should theoretically also make a lower low. Shutterstock. Explore. But imagine if euro to US dollar makes a lower low, dropping below a key support, but pound sterling to US dollar refuses to make a lower low and instead makes a higher low. This is a crack in the correlation. It is a divergence. It suggests that the selling pressure on the pound is being absorbed by a massive institutional buyer. The crack in the correlation reveals the hand of the smart money. When you see this, it is often a leading signal that a reversal is imminent for both pairs. The one that failed to make the lower low is usually the leader, the stronger horse that you want to bet on. This web of connections extends to commodities as well. The Canadian dollar CAD has a historic positive correlation with crude oil. If oil prices are skyrocketing, the loonie CAD often strengthens. If you are trading US dollar to Canadian dollar, you must have an eye on the oil chart. If oil is breaking out to new highs, trying to buy US dollar to Canadian dollar is fighting a fundamental headwind. Similarly, the Australian dollar often tracks with gold prices. These intermarket relationships provide confirmation. You never want to take a trade based on one isolated piece of data. You want a confluence of evidence. You want the technicals, the time of day, and the intermarket correlations to all point north. By now, you might feel overwhelmed by the variables. You have to watch the DXY, check the correlations, scan for SMT divergence, and monitor oil and gold. This is the reality of professional trading. It is not about drawing a line and hoping. It is about information synthesis. It is about building a case like a lawyer in a courtroom, where every piece of evidence supports your verdict to buy or sell. However, even if you master the DXY, perfect your timing, and nail the correlations, you are still mathematically destined to fail if you do not understand the casino math of your own account. You can have a 90% win rate and still go broke. You can have a 30% win rate and become a millionaire. The difference is not the strategy. The difference is the position sizing. We are about to cross the threshold into the most boring, yet the most vital part of this entire masterclass. The part that separates the gamblers from the business owners. Most people ask, how much money can I make on this trade? The professional asks, how much money can I lose on this trade? We are going to explore asymmetric risk-reward. We are going to dismantle the myth of the win rate. In the next part, we will construct the mathematical formula that ensures that even if you lose 5 trades in a row, your account is still standing strong, ready to catch the winner that pays for everything. The strategy finds the trade, but the risk management keeps the money. Let's play a game. Imagine I offer you a coin toss. If it lands on heads, I pay you $1. If it lands on tails, you pay me $1. Would you play this game? Probably not. It's a waste of time. You have a 50-50 chance and the payout is equal. Over 1,000 tosses, you will likely break even minus the time you wasted. Now imagine I change the rules. If it lands on tails, you still pay me $1. But if it lands on heads, I pay you $3. Would you play now? You should. You should play that game until your hands bleed from flipping the coin. Why? Because even if you lose 5 times in a row, losing $5, all you need are 2 wins to make $6, covering your losses and putting you in profit. Shutterstock. This is the concept of asymmetric risk-reward, or R multiple. It is the mathematical heartbeat of professional trading. Most retail traders are obsessed with being right. They want a 90% win rate. They want the dopamine hit of seeing green on the screen every single day. To achieve this, they often adopt a strategy where they risk 50 pips to make 5 pips. They are picking up pennies in front of a steamroller. They might win 9 times in a row, making 45 pips total. But on the 10th trade, the market moves against them, hits their 50-pip stop loss, and wipes out weeks of progress in a single afternoon. This is negative risk-reward. It is a strategy designed for the ego, not for the bank account. The professional flips this equation on its head. The professional does not care about being right. They care about the expectancy of the trade. They look for setups where they can risk 1 unit to make 3 units. This is a 1-to-3 risk-to-reward ratio. Let's look at the math of a 1:3 strategy over a sample of 10 trades. Imagine you take 10 trades. You are risking 1% of your account on each trade. You are having a terrible week. You lose 7 trades. You are wrong 70% of the time. Most people would quit. But let's do the math. 7 losses at -1% equals a 7% drawdown. But you won 3 trades. Each win paid out 3%. 3 times 3 is 9%. 9% gain minus 7% loss equals a net profit of 2%. Let that sink in. You failed 70% of the time. You were wrong more than you were right. You felt the pain of losing 7 times. Yet, you are up 2% on your account, outperforming most hedge funds and bank savings accounts. This is the secret that the 10% know. You do not need to be a fortune teller. You just need a mathematical edge. If you can maintain a 1-to-3 risk-reward ratio, you only need a win rate of roughly 25% to break even. Anything above that is pure profit. However, knowing the ratio is useless if you do not know how to size the position. This is where position sizing comes in. This is the most common technical error new traders make. They think in terms of lots. They say, I trade 1 standard lot. This is suicide. A standard lot has a different value depending on the pair and the quote currency. Furthermore, a fixed lot size ignores the structure of the market. If you are trading a tight consolidation on the 5-minute chart, your stop loss might be 10 pips away. If you are trading a massive swing on the daily chart, your stop loss might be 100 pips away. If you use the same 1 lot size for both, you are risking 10 times more money on the daily trade than the 5-minute trade. Your risk is volatile and unpredictable. You must stop thinking in lots and start thinking in percentage risk. The formula is non-negotiable. Risk amount equals account balance x risk percentage, e.g. 1%. Position size equals risk amount / stop loss distance in pips. Let's run the numbers. You have a $10,000 account. You risk 1%, which is $100. Scenario A. You find a trade with a 20 pip stop loss. $100 divided by 20 pips equals $5 per pip. You trade roughly 0.5 lots. Scenario B. You find a trade with a 50 pip stop loss. $100 divided by 50 pips equals $2 per pip. You trade roughly 0.2 lots. In both scenarios, if the trade hits your stop loss, you lose exactly $100. The distance of the stop loss changed, so your lot size adjusted to keep your risk constant. This is how you survive. You standardize your loss. No single trade should ever have the power to ruin your day, let alone your career. By risking only 1%, you have 100 lives in this game. You would have to lose 100 times in a row to blow your account. Even a random number generator buying and selling blindly would struggle to lose 100 times in a row. This leads us to the terrifying concept of drawdown and the recovery calculation. Losses work geometrically against you. If you lose 10% of your account, you need an 11% gain to get back to break-even. That is manageable. But if you get reckless and risk 10% per trade, and you lose 5 times, you are down 50%. To recover from a 50% loss, you do not need a 50% gain. You have 5,000 left of your 10,000. To get back to 10,000, you need to make 5,000. That is a 100% gain. You have to double your money just to get back to the starting line. If you lose 90% of your account, you need a 900% gain to break even. That is effectively impossible. This is why the stop loss is not just a tool. It is an emergency brake. It prevents a bad day from becoming a terminal illness. The traders who blew up their accounts did not lack strategy. They lacked the discipline to cut a loser before it became a math problem they couldn't solve. We must also address the psychological component of risk-reward. The temptation to close early. Imagine you are in a trade. You risked $100 to make $300. The trade goes in your favor. You are up $100. The market stalls for a moment. Fear kicks in. You think, I should take this profit before it turns around. You close the trade. You banked $100. You feel good. But you just broke your math. You turned a 1:3 trade into a 1:1 trade. If you do this consistently, your 30% win rate strategy, which relied on those big wins to pay for the losses, suddenly becomes a losing strategy. You are feeding the losses but starving the winners. The hardest thing to do in trading is not entering. It is sitting on your hands while a winning trade develops. It is watching the price retrace halfway back to your entry and trusting your analysis enough to hold for the target. This is where partial profits and trailing stops come into play. A professional compromise is to take partials. If the trade hits 1:1, you are up the amount you risked. You close 50% of the position. You have now banked some cash and removed the risk. You can move your stop loss to break even. Now the trade is a free roll. If it hits your target, you win big. If it reverses, you lose nothing. This quiets the reptile brain that screams at you to take the money and run. We have now constructed a fortress. We have the structural map to find the direction. We have the order blocks to find the entry. We have the time of day to find the momentum. We have the correlations to confirm the move. And now we have the risk management to ensure we survive the losses and maximize the wins. On paper, you are now a profitable trader. You have a business plan that works. But here is the cruel irony. You can give two people the exact same strategy, the exact same risk management plan, and the exact same chart. One will make $1 million and the other will go broke. Why? Because trading is not played on a chart. It is played between your ears. The greatest enemy you will face is not the central bank, not the algorithm, and not the high-frequency trading bot. The enemy is the amygdala, the primitive part of your brain that controls fear and greed. It is the voice that tells you to move your stop loss when the price gets close to it. It is the voice that tells you to double your bet to win back what you lost. In the next part of this masterclass, we are going to leave the charts behind and enter the mind. We are going to explore trading psychology and the state of flow. We will discuss why 90% of trading errors are emotional, not technical. We will uncover why you self-sabotage right when you are about to succeed. And I will give you the mental frameworks to turn off the noise and execute like a machine. The strategy is ready. The question is, are you mentally tough enough to trade it? Let's find out. There is a biological glitch in your brain that is actively trying to make you go broke. This is not a metaphor. It is an evolutionary fact. For thousands of years, the human brain evolved to survive in a physical environment where threats were tangible. A rustle in the bushes meant a predator. The correct response was immediate, visceral fear, fight or flight. Your adrenal glands pump cortisol, your heart rate spikes, and blood rushes away from your prefrontal cortex, the logical decision-making part of your brain, and into your muscles. You become stronger, faster, and significantly stupider. This mechanism kept your ancestors alive on the savannah. Giddy images. But in the Forex market, a red candle is not a tiger. A drawdown is not a physical attack. Yet, your amygdala, the primitive fear center of the brain, cannot tell the difference. When you see a trade go against you, your body reacts as if you are dying. You freeze. You panic. You make irrational decisions to stop the pain. You move your stop loss because you cannot accept the reality of the loss. Or, conversely, when you are winning, you feel a rush of dopamine and euphoria. You feel invincible. You double your position size because you can't lose. Both of these states, fear and euphoria, are fatal to a trader. This emotional roller coaster is known as the cycle of doom. Starts with optimism. You enter a trade. Goes your way. You feel excitement. Keeps going. You feel thrill. You think, I am a genius. I have figured this out. Then the market turns. You feel anxiety. It's just a pullback, you tell yourself. The price drops below your entry. You feel denial. It has to come back up. The fundamentals are good. The price hits your stop loss, but you remove it. You feel fear. The loss becomes significant. You feel desperation. Please God, just let me break even. Finally, you hit the point of maximum pain, panic. You close the trade at the absolute bottom. Then you feel depression. You stare at the screen defeated. And inevitably, 10 minutes later, the market reverses and goes exactly where you thought it would. This cycle is driven by a psychological phenomenon called loss aversion. Behavioral economists have proven that the psychological pain of losing $1,000 is twice as intense as the pleasure of winning $1,000. This asymmetry causes traders to do the exact opposite of what the math dictates. To avoid the pain of a loss, they hold on to losing trades for days, hoping for a miracle. To secure the fleeting pleasure of a win, they cut winning trades early, terrified the profit will disappear. They cut their flowers and water their weeds. Let's run an imagine if scenario to reframe this. Imagine you are the owner of a casino in Las Vegas. You have a roulette table. A player walks in, puts $100 on red and wins. He cheers. He takes $200 from you. Do you, the casino owner, panic? Do you get angry? Do you try to trip him on the way out to get your money back? No. You smile and offer him a free drink. Why? Because you know the math. You know that the wheel has a green 0 and double 0. You have a statistical edge of roughly 5.26%. You know that over a sample size of 1,000 spins, the house always wins. The individual spin is irrelevant. The player's win is just a cost of doing business. To succeed in Forex, you must surgically remove the gambler identity and install the casino identity. You must stop caring about the individual trade. Most traders judge their success by the outcome of their last trade. If they won, they are good traders. If they lost, they are bad traders. This is result-oriented thinking, and it is a trap. You can make a terrible, reckless decision and win money, lucky outcome. You can make a perfect, disciplined decision and lose money, bad outcome. If you reward yourself for being reckless just because you got lucky, you are reinforcing a habit that will eventually destroy you. This brings us to the concept of thinking in probabilities. This is the mental framework championed by legends like Mark Douglas. When you put on a trade, you are not predicting the future. You are simply stating that, based on your edge, the strategy we built in parts 1 to 8, there is a higher probability of one thing happening over another. Once you click buy, the outcome is out of your hands. It is random. A bird could fly into a server farm in Tokyo and crash the yen. You cannot control that. The only thing you can control is your reaction. This is where the mental stop loss comes in. We talked about financial stop losses, but you also need a psychological one. This is a rule that says, if I lose 2 trades in a row, I walk away for the day. Why? Because after 2 losses, your objectivity is compromised. You are now prone to revenge trading. Revenge trading is the most destructive force in the market. It is the burning desire to get back what was taken from you. You enter a trade immediately after a loss, usually with larger size, and usually without a setup. You are angry at the market. You want to punish it. But the market is an inanimate object. It does not know you exist. Trying to get revenge on the market is like trying to get revenge on the ocean for getting you wet. You will only drown. Let's look at a case study of a tilt spiral. A trader named Sarah has a rule to risk 1% per trade. She takes a loss on euro to US dollar. She is down 1%. She feels annoyed. She sees pound sterling to US dollar moving fast. She jumps in, ignoring her checklist, risking 2% to make back the 1% plus profit. The trade chops around and stops her out. She is now down 3%. Her face is hot. She feels stupid. She thinks, I need to fix this now. She opens a gold trade with 5% risk. Gold always moves, she thinks. Gold spikes against her. She freezes. She doesn't close it. She watches the loss grow 5%, 10%, 15%. Finally, the broker margin calls her. She lost 20% of her account in 1 hour. This is not a lack of strategy. Sarah knew how to trade. This is a lack of emotional regulation. So how do we achieve the elusive state of flow or the zone? The zone is a state of mind where you are completely aligned with the market. You feel no fear, no hesitation, and no compulsion. You just execute. To get there, you must accept the risk completely. Before you enter a trade, ask yourself, if this money vanishes right now, will I be okay? If the answer is no, you are trading too big. You cannot be objective if you are trading with your rent money. You need to be detached. A powerful technique to build this detachment is the sample size exercise. Commit to taking 20 trades. Tell yourself, I do not care about the result of any single trade. I only care about the result of the block of 20 trades. This relieves the pressure. If trade number 1 is a loss, it doesn't matter. You have 19 more to go. You are just executing the system. You become a data entry clerk for your strategy. Furthermore, you need to cultivate self-trust. Self-trust comes from following your rules, not from winning. Every time you move a stop loss, you are telling your subconscious, I am a liar. I cannot be trusted. Every time you stick to your plan, even when it loses, you are building mental callus. You are telling yourself, I am disciplined. Over time, this discipline reduces the fear response because you know that no matter what the market does, you will not do anything to hurt yourself. Journaling is the tool that cements this, but not just a spreadsheet of numbers. You need a psychological journal. Before you trade, write down how you feel. I am anxious because I had a fight with my spouse. I am greedy because I saw someone on Instagram make money. If you identify these emotions before you trade, you can choose not to trade. You can spot the enemy before he breaches the gates. We have now traveled a long road. We have dismantled the misconceptions, built the technical arsenal, mastered the clock, hedged the risk, and fortified the mind. You have all the components of a professional trading machine, but a pile of car parts is not a Ferrari. You need to assemble them. You need to turn these abstract concepts into a concrete, actionable routine that you can execute tomorrow morning at 8 a.m. You need a business plan. Not a vague idea, but a written document that dictates exactly what you do from the moment you wake up to the moment you shut down the screens. In the final part of this masterclass, we are going to build that plan together. We are going to synthesize everything: market structure, order blocks, time of day, risk management, and psychology into a cohesive daily protocol. This is the bridge between knowing and doing. This is where the rubber meets the road. Part 10 is the graduation. Are you ready to go pro? You now possess the engine of a Formula One car. Over the last 9 episodes, we have assembled the chassis of market structure, the tires of risk management, the fuel of intermarket analysis, and the steering wheel of psychology. But a Formula One car sitting in a garage wins no races. It is just expensive metal. To win, you need a driver and you need a race strategy. This final installment is your operations manual. It is the bridge that crosses the chasm between knowing how to trade and actually being a trader. Most people fail not because they lack knowledge, but because they lack organization. They wake up, check their phone in bed, see a green candle, and buy. That is not a business, that is a gambling addiction. We are going to construct a rigid, boring, professional daily protocol. This is a checklist that you must follow with the precision of an airline pilot before takeoff. If one box is not checked, the plane does not fly. You do not trade. The protocol begins long before the market opens. This is the pre-flight assessment. Step 1 is the environmental check. You open the economic calendar. You are looking for red folder news events, CPI, NFP, FOMC meetings, or central bank speeches. If Federal Reserve Chair Jerome Powell is speaking at 2 p.m., you write that down in bold red ink. Why? Because you know that from 1:30 p.m. to 2:30 p.m., the market will be a chaotic liquidity hunting machine. Your rule is simple. We do not open new positions 30 minutes before or after a high-impact event. We preserve capital. If the calendar is clear, or the news is hours away, we proceed to step 2. Step 2 is the top-down analysis. You do not start on the 5-minute chart. You start on the daily and the 4-hour charts. You are looking for the narrative. Ask yourself, where is the daily liquidity? Is the previous day's high a target? Is there a massive 4-hour order block sitting below the current price? You draw your zones. You mark your points of interest, poise. If the daily trend is bearish, you are only interested in looking for sell setups. You are filtering out half the market noise immediately. You are not guessing, you are hunting. You identify a specific zone. Let's say a bearish order block on pound sterling to US dollar at 1.2500. You set an alert on your charting software for 1.2480. Then you step away. This is the hardest part for the amateur, the wait. You do not stare at the screen. You do not force the market to move. You wait for the price to come to your designated kill zone. Let's say your alert pings at 8:30 a.m. Eastern Standard Time, right as the New York session opens. This is the moment of truth. Step 3 is the lower time frame execution. The price has entered your 4-hour POI. Do you sell immediately? No. That is catching a falling knife. You switch to the 15-minute or 5-minute chart. You are now the sniper. You are watching for the reaction. You want to see the buyers try to push price up and fail. You want to see a shift in market structure on this lower time frame. You want to see a 5-minute candle aggressively close below a previous higher low, leaving a fair value gap behind. This fractal break confirms that the 4-hour zone is holding, and the sellers have arrived. Step 4 is the risk calculation. Before you click sell, you use your position size calculator. You measure the distance from your entry to your stop loss, which should be placed just above the swing high that created the break. Let's say it is 15 pips. You have a $10,000 account. You are risking 1%, $100. The calculator tells you to sell 0.6 lots. You enter the limit order. Now you are in the trade. Step 5 is trade management. This is where emotions try to hijack the plane. Your heart rate rises. The price moves against you slightly. You want to close it. But you look at your protocol. The rule says, I do not touch the trade until it hits my first target or my stop loss. You have accepted the risk. You are the casino. You let the probabilities play out. Let's imagine the price drops. It moves 15 pips in your favor. You are now at a 1-to-1 risk-to-reward ratio. Your protocol dictates a specific action here. Take partial profits or move stop to break even. You decide to close 50% of the position to bank $50, and you move your stop loss to your entry price. You have now neutralized the risk. You cannot lose money on this trade. You have earned the right to relax. The remaining 50% of the position is your runner. You target the liquidity pool at the previous day's low, which offers a 1:4 risk-reward return. Step 6 is the postmortem. Win or lose, the work is not done when the trade closes. You open your journal. You capture a screenshot of the chart. You write down the setup, e.g., for H order block plus 5M SMS. You write down the result. And most importantly, you write down your state of mind. Were you anxious? Did you hesitate? Did you exit too early? This data is more valuable than the money. Over time, this journal reveals your personal flaws. You might notice that you lose 80% of trades taken on Mondays. The solution? Update the protocol. I do not trade on Mondays. You just increased your profitability by doing less. This protocol creates a feedback loop of continuous improvement. But let's look at the bigger picture. Let's look at the compound effect. Imagine you only take 3 of these high-quality trades a week. Just 3. You lose 1-1%. You win 2, total plus 6% if risking 1:3. Your net result is plus 5% for the week. To the get-rich-quick crowd, 5% a week sounds slow. They want to double their account in a day. But do the math. If you compound a $10,000 account at 5% per week consistently for 1 year, you do not end up with $35,000. You end up with over $120,000. In 2 years, you are a millionaire. This is the geometric power of consistent, boring, disciplined execution. The challenge is not finding the 5%. The challenge is not blowing the account on the bad weeks so that the math has time to work its magic. There will be weeks where you lose. There will be weeks where the market is choppy and you sit on your hands for 5 days straight, taking 0 trades. This is where you earn your stripes. The amateur gets bored and forces a trade, losing 2%. The professional stays flat, preserving the capital for the next week when the conditions are perfect. In trading, flat is a position. Protecting your chips is just as important as winning more chips. You must also understand that this journey is lonely. Your friends will not understand what you do. They will ask for stock tips. They will ask if it is like gambling. You cannot explain the nuance of a liquidity sweep or an institutional order block to them. You have to find your community, your tribe of 10%ers. But ultimately, when you are sitting in front of the screens at 2 a.m., it is just you and the mirror. The strategies we have explored, swing trading, day trading, scalping, are just tools. A hammer can build a house or it can crush a thumb. The difference is the skill of the carpenter. You are the carpenter. The market will test you. It will try to break you. It will give you a winning streak to make you arrogant, and then a losing streak to crush your spirit. It will probe every single psychological weakness you have. If you are impatient, it will make you wait. If you are greedy, it will bait you. If you are fearful, it will scare you out of the best moves of the year. This is why trading is often called the ultimate path to self-mastery. To succeed, you have to become a better version of yourself. You have to become disciplined, patient, humble, and objective. You have to kill the ego to save the portfolio. So, here is your graduation assignment. Do not go fund a live account with your life savings today. Take this protocol. Open a demo account or a very small live account. Commit to taking 100 trades following this exact system perfectly. Do not deviate. If you can survive 100 trades and break even, you are ahead of 90% of the world. If you can make a profit, you are on your way to freedom. The deep dive is complete. The map is in your hands. The giants are moving, the liquidity is flowing, and the market is open. Turn off the noise, focus on the process, and let the probabilities fall where they may. Welcome to the profession.